Okay, let's move on then. And as promised, CLSA, let's get the conversation going. CLSA in a recent note said that the China stimulus package is a good start, but not a panacea for China's issue. They added that the constraint on stimulus is already stretched budget and elevated public debt. To discuss more, this and more, we have Alexander Redman, Chief Equity Strategist at CLSA, joining in. Alexander, thank you very much for joining in. This is Reema here. I think that's the big question now. What we've heard from China and what perhaps might come in the future. Is the Chinese market, should we look at the Chinese market tactically, or is it good structurally for the next 3 to 5 years? Wayne, with your opinion.
Yeah, very good morning. I think that is the key question. What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. But I think what really differentiates the current episode is going to be whether you get the fiscal follow through from the Chinese government. We've had 4 full storms, so 4 bear market rallies in Chinese equities since March 22. And each one has petered out after about 3 or 4 months and after no more than about 40% gain, as the market has come to the realization that the fundamental economic challenges that China faces have not actually been resolved. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, I mean, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. If you look at the current inventories with developers versus the current rate of sales, it represents about 3 years worth of inventories that they've yet to clear. And that doesn't include the 12 to 15% of the housing stock in China, which has been bought speculatively. So add all of that up and you've got a lot of inventory to digest, and you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
So, Alex, great to have you with us here on the program. So you're saying we need to obviously watch the property market very carefully to see if there is any sort of a durable rebound. Is that going to be the best indicator of whether this is the real thing? What else will tell us that this is the real thing?
I need to see multiple changes and indicators. I mean, what we need obviously is for property prices to begin to turn up. Certainly, I mean, this is critical. 51% of household wealth in China is still sitting in property. You know, are you, as a member of a Chinese householder, going to feel sufficiently confident to go out and acquire more property if prices are still falling? You know, highly unlikely. But equally, what I would like to see is consumer confidence broadly begin to come up, and also importantly, consumption. And this again is, I think, a key topic, because as we're all aware, China's economy at the moment is still remarkably imbalanced away from consumption. Its consumption share of GDP is only about 56%. If you look at the other large global economies, India included, it's between 70 and 82. So China needs to take policy measures which will unlock savings. At the moment, you have about 115% of GDP sitting in savings. So much of that could be deployed into consumption. It's just whether the government is prepared to take those steps to actually unlock China's consumption potential going forward.
But would you say to some extent this China rally that we've seen is a bit of a hope trade, because this fiscal stimulus package of 2 trillion yen, which has been talked about, hasn't been officially announced by the government there?
Mm-hmm. No, you're right. I mean, what we heard, the genesis of the report, I think, came from Reuters. There was 2 trillion renminbi, split roughly in half. I mean, the idea was that half would go to refinance local governments and allow them to carry on the purchases of excess real estate inventory, and the other half aimed more at stimulating consumption. But as you say, this remains unformulated. I mean, last Tuesday, you had a relatively precise delivery on the monetary policy side and regulatory changes from the PBOC and the securities regulators. And then on Thursday, we had some sound bites that came out of the September Politburo meeting, all about arresting the falls in real estate and trying to encourage spending in China. But as you say, pretty light on detail.
Okay, so got that. So you've spoken a good bit on China. Alexander, the question really is for us sitting here in India is what does it mean for us? And we've seen the first sign of real FII selling in the last 2-3 days. And I go back to a call that your India analyst Vikas Jain made, that he said the quote-unquote Modi stocks, they are perhaps most vulnerable to profit taking. So what's the stance on India?
I mean, India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are three things which I've been looking at to break that complacency. And essentially, it's an interruption to retail investor appetite. A large pickup in issuance. In other words, you get IPOs to the level that you can swamp the secondary market. And also any changes to the oil price. And what you've seen actually in the last week or so is all three of those come into play. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggregated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So, the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination are certainly testing the Indian market. And as you say, compounding that, there's certainly some scope for rotation. Now, I think we need to be careful here because if you look across emerging markets, India is one of the most domestically owned markets, and that is quite a moat for India. It's very protective. 83% of the market is owned domestically. I mean, if you go to Latin America, that number falls below half. And so with only about 17% of India owned by foreigners, and most foreign investors actually sitting, at least anecdotally, at underweight positions because they find it difficult to stomach the valuations, I think there will be relatively little drawdown on Indian equities to rotate into China. I see a more obvious source of that being Japanese equities or Korea or Taiwan as we get towards the end of this tech cycle.
Quick one-word answer, Alexander. On US elections, who's better for emerging market equities? Kamala Harris or Donald Trump?
Look, I think there are some key differences here. I can't really do it in one word, but I'll try and be brief. Look, the differences are, I think, obviously on tariffs. That's very well flagged. We know about that. But equally, there's some more nuanced differences. I think Trump's agenda is far more inflationary. He stands for deregulation, cutting taxes, implementing tariffs. And I think that what that will do is complicate the Federal Reserve's ability to ease in a Trump administration. So I think what would really differentiate Trump and Harris from an emerging market standpoint is three things. One, the Fed's capacity to ease. And that would have a knock-on effect on Asian and emerging market central banks' capacity to follow through. Secondly, the dollar, of course, because if the Fed is unable to cut as much, then the dollar will remain relatively strong, and that's always proved a headwind to emerging market equities. And thirdly, on the earnings side, what brought the EM rally to an end in 2018 was as much the start of the trade war as Donald Trump's tax cuts. He took the tax rate, corporate tax rate in the US down from 35 to 21. What that did was give a boost to US earnings growth. The relative earnings differential between the US and emerging markets then went up. And that made emerging markets overall look less attractive. So what really differentiates on the tax and earnings side between Harris and Trump is that Harris wants to take the U.S. Corporate earnings growth back up to 28%. Trump wants to cut it further to 15%. So under that environment, the EPS differential for emerging markets would look better within a Harris administration than Trump. So overall, I would conclude that Harris certainly, I think, is more favorable for emerging markets for those macro reasons.
That's a great point, Alex, and thank you for highlighting that, because there's so much debate around U.S. elections. I think the central issue, which is tax, is perhaps not discussed enough. Thank you very much for all the perspective. Great having you on. We hope to have you more often on the show in the coming weeks and months as well.